Ladies and gentlemen, a presidential sighting. Michael Rubel in the studios of Hurley in the Morning. Good boss. Great boss, actually. And programming note, station event note. This Sunday, and it is such a phenomenal time. Every year we've been there. We're going to be there this weekend with Noah. It is the annual Town Square Media Safe Trick or Treat. 11 a.m. to 1 p.m. at Birch Grove Park. It's literally right next door to Broadcast Center down Burton Avenue. It's a costume contest, bounce house, magic show by magician Chad, and he's so good. It's so much fun. There'll be hay rides, pumpkin picking, candy. It's a great time. It's brought to you by ShopRite, by Petrosh's Big Top Tent Rental in Egg Harbor City, and Miller's Haunted Hayride in Hamilton. Ladies and gentlemen, we feather immediately post-haste to the official financial advisor to Hurley in the Morning for the past 25 years, Chuck Malamut, Managing Director, leader of the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010 to reach Chuck and his team. And this program that we've been blessed to do together for the past 25 years is brought to you by Chuck, a financial advisor with Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information that's provided here nor any opinion expressed constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Mr. Malamut, good to be with you, my good friend.
Good morning, Harry. How are you today?
Good. Your phone's ringing. My phone's ringing. Brother Billy's checking in, so you know it's a Tuesday.
We get our weekly update call, or text message, I should say, regarding our weekend results. And certainly, Harry, I think you and I should definitely stick to our day jobs.
Well, the only caveat to that is it's a very unpredictable year. Literally the parity in the NFL right now, with the exception of probably the New England Patriots, because even Denver, that's 6-0, they've had a number of close games. They didn't cover the spread last weekend. I mean, I thought they would. They needed to win by like 5 points. They wound up winning, I think, by 4. So the 4.5 you lose. We have had a lot of good years in this totally for fun, thing that we do. It's only entertainment purposes. But it's been challenging. I mean, it's tough to pick. I will say, though, that it took 6 weeks, but finally I picked the Eagles to win, and they won, and they covered the spread. Every other week that I either picked them to win or lose, they did the opposite. So the Horns, I've escaped that with the Eagles. And while the Eagles played a little bit sloppy last night, Chuck, 27-7 over the team that had been leading the division. It's a good win for them.
Yeah, Harry, unfortunately I did not have an opportunity to watch much, but what I did see, a team that maybe is starting to get its act together after several weeks of some disappointing results. But this is a marathon, it's not a sprint. And clearly evident at the end of the regular season, we'll see who's left standing.
Yep.
And what magnitude. But I do agree with you.
And by the way, the NFC East, it could be a team with a whole lot of losses.
It could be sub 500.
Yeah, I'm thinking 8-8, but could be even 9-7.
But you're right. When you look at a team, there are still, I believe, 5 undefeated teams, and really, clearly the only one that really stands out is New England.
Yeah, because you kind of look at Carolina; they look like they could lose like half the games they've won, and the other ones. New England right now looks unbeatable, but then again, Indianapolis played them 34-27 and made a fourth down mistake. So they were right there.
Yeah. So anyway, Harry, let's feather into. I don't know. There's not really a great segue, but
let's say market update.
Let's talk about the equity markets here in particular. I mean, last week it's not getting very interesting. In as much that we worked through the August-September lows. The S&P was up just shy of 1% for the week. Third quarter earnings have been mixed at best, and it seems as if we're back to the record sort of rewriting itself. It's a repeat where what do we see on the top line? majority of the companies to date, and it's still very early in earnings season, misses on the top line.
Yeah, consistently it seems so.
Now, a lot are still either getting to the EPS, the bottom line number, earnings per share, or they're either right or there's a slight miss. Companies that are missing top line and bottom line are, they get taken out to the woodshed very, very quickly, as evidenced in a couple positions yesterday. And today, and again, you never want to look on a day-to-day basis, but obviously we are all concerned about earnings at this point in time because of what happened in the latter part of the summer. But we're starting to, I think, Harry, today, maybe I saw 5 or 6 before I got here this morning, and there were a couple companies that did, in fact, beat the top on the top line and the bottom line. So that's...
Although pre-market headline right there, earnings woes hit Wall Street.
Well, look, you're gonna go day to day, week, hour by hour, company by company, and at the end of the day, I think that what we have witnessed in the last couple weeks is that third quarter earnings results are now mixed, and they have been, analysts have projected lower. Investors are really focused on the fact that it's gotten fairly quiet in China. You have some stabilization, and there's been a lot of discussions about the Fed. When's the Fed going to move? How much are they going to move? When are they going to move? And so it seems as if rates are going to remain fairly steady at this point in time.
Let me ask you a question, because we talk about geopolitical stuff. Is it a big deal that Trudeau mania is sweeping Canada right now? Harper has been swept out. Trudeau, obviously a legendary, iconic name in Canada. Trudeau is in. And with the promise, they ran the whole campaign, we will deficit spend. And they got a resounding 2-1 win. The Liberals did over the Conservatives, with another Democrat Party getting 30 seats on top of that. So when you add, the first has a majority. Trudeau has a comfortable majority, like nearly 200 seats in Parliament, but there's another 30 that were even be more left than he would be. When they promise, vote for me because we will spend and deficit spend our way out of misery, and you win with that, do the markets get affected by that?
On a short-term basis, they could very well. But I think this is a precedent that's being set in Canada, and hopefully it works to the benefit of the country. I mean, Canada's obviously had a number of issues, and I think the fact that, Harry, they are so dependent on their natural resources. And, I think all your listeners understand.
Oil in particular, right?
What is happening with oil in particular and gas. I mean, it's going to hurt their growth. So, the markets in front of that vote, were somewhat rattled. The Canadian dollar weakened on news of the victory, although most analysts think the currency, they don't expect much change on a long-term basis. So, I'm real curious, Harry, as to what's going to happen with the relations with Canada and U.S. at this point in time. So, I think that could be very, very important.
Well, wouldn't you think that from an executive branch standpoint, the new, pretty much ultra-liberal Trudeau government should be lockstep with our administration?
Well, we'll see. Only time will tell.
But I don't know why that would be good.
Well, I mean, I think the relationships need to be repaired, and I think Canada needs to get on a better footing with our country. I mean, that's unfortunate.
Well, okay, then we'll call that. Then that will probably happen. But if their policies are wrong,
well, no, forgetting. Yeah, I mean that's a whole.
Getting along with somebody and be wrong.
We won't get into that discussion at this point in time. But
fair enough.
So
you can see why my mind would go that way, though.
So as you take a look at where we were, one of the things that we chatted about as we got into the middle of the year is the fact that there was a lot of concern with respect to certain sectors within the market. And lo and behold, last week, the three winners were utilities, healthcare, and telecom. So as we look at this right now, year to date, within the S&P, but if I asked you, Harry, what do you think the market has done year to date? What would your reaction be?
The bias immediately would be that we're down.
Okay, but what, 5%, 10%?
Based on, I know where we're going because I really do know what it is, and I literally just looked at it before I was talking about the pre-markets and some of their comments. What I would think it is substantially worse than what it really is, and that's a problem because that's psychological perception versus reality. Honestly, it feels like a low double-digit type of situation.
Yeah. So going into yesterday, which was pretty much a nothing day, the S&P is actually up 0.4%.
Doesn't feel like it though, does it?
The Euro Stoxx is up 0.6%. So, and I think what happened was that the market caught the average investor by surprise last August, and we had those just awful 10 days where we had a fair number of calls reminiscent, unfortunately, Harry, 2008 and 2009. It's been a great run that we've had, and we want to protect our principal. Get me out because the world's going to end. We had that call from several people. And as it turned out, it's like anything else. If you stuck to your disciplines and, reworked the plan, so to speak, based upon your goals and your aspirations and your asset allocation modeling and your rebalancing, you would be just fine right now at this point in time. I think all of us are concerned, and I think that you mentioned it just last week or the week before. Would you consider, 2015 a throwaway year? And, unless something were to dramatically happen to the upside in the fourth quarter, that's, I think, what we're faced with at this point in time. And unfortunately, it does happen on occasion.
Can you have, because there's been several good years in this past 7 years, there have been several strong years from just a pure sort of financial standpoint, but yet sort of a lost 7/10 of a decade. Is this going to be at the end of this a lost decade to some extent too? And I don't mean this purely just from a market standpoint.
Well, I mean a lost decade with respect to what, the economy?
Economy in general, people's perception of the economy, jobs, the lowest job participation rate, relationships with both allies and enemies. I'll throw in geopolitical assessments into that statement as well. I think you could make the case.
Well, Harry, if you take a look from the time that we got through the Great Recession, our economy has not been firing on all cylinders for quite some time, and as on occasion has slowed.
They even tried to float things like the new normal.
Yeah,
to make abnormal appear to be normal just by saying it's new and it's normal.
The labor market, and we did talk about this last week, I believe, has been relatively strong for the most part. And again, it's a matter of how you view that and what
for record-keeping purposes.
What set of eyeglasses are you wearing?
But for record-keeping purposes, there is a good story to tell.
Yeah. Retail sales have been somewhat uneven. And again, we're, all kinds of projections as to what's going to happen this Christmas season. Consumer spending levels have advanced at somewhat a respectable pace. But where we have been hurt is in manufacturing. If you look at U.S. manufacturing, it has been lagging. That is a concern. But the question is at hand: does this drop in manufacturing, lead, to bigger problems, broader problems in our economy? So, we think that the manufacturing sector will pick up over time. Spending levels will continue to rise, and the negative effects that we see from the stronger dollar and lower oil prices should ultimately fade. So, to answer your question, I don't think it's a lost decade. I think it's been somewhat, for all of us, misguided.
I want to believe what you said, but I do think it's nearly a lost decade because what's been done is so, I think, deep and injurious. But I wholly respect what you say. We have to take a quick timeout, split decision on that point. We'll be right back. Much, much more. We're going to cover corporate earnings. We're going to talk about the Fed. We'll talk about market volatility and who knows what else over the next 20 minutes straight ahead with Chuck Malamut, the official financial advisor to the Hurley in the Morning program, managing director of his team, the Malamut Group at Morgan Stanley's Northfield office. This much I can tell you with utter certainty. For all of your financial planning needs, turn to Chuck, who has perfected his concept of total asset management coupled with the all-important asset allocation. 609-383-2010, the number to reach the Malamut team, 609-383-2010. We'll be back in a few minutes. 24 minutes past the hour. I am Harry Hurley. This is Hurley in the Morning, but more importantly, it is the Chuck Malamut program. Chuck presents a very, very smart program all about your financial matters. And Chuck, the time is yours.
So, Harry, we got to the break and we were talking about U.S. manufacturing, and I guess to kind of go full circle, we need to take a look at what is happening not only here in the U.S. We seem to be in better shape at this point in time than most other parts of the world. We are seeing some positive signals coming from Europe, where non-manufacturing activity is stronger than the manufacturing sector. How developed markets as we know them today have had choppy growth, I guess is the best way to kind of describe it. And many of the EU, the emerging countries as we know them, are having a really tough time, after they boomed for the last decade. So, that's a feast or famine type scenario. So, in particular, any of the resource-related economies that we guys talked about, Canada, they're not obviously an emerging market, but, rely on natural resources. They are certainly struggling. So, it's sort of a catch-22 as to where we're going to go with all this. We have continuing growth here in the U.S. We have continuing growth in Europe. China is now starting to look – I mean, the numbers are not great coming out of China, but it looks as if there's some stabilization. And the commodity markets, as we know them, have somewhat calmed down. I mean, you think about where we were just at the end of August. It was, it was like a free fall at times where you just were waiting, for the next price to print, and you're hoping that that a particular market would continue to function. So, I think in a relatively short period of time, we've come a long way, and it's just a matter. I think what has happened here, as you mentioned a few minutes ago, the average retail investor is wrung out. I mean, they're just tired. You've had this decade, and granted, you take a look at, 2007, 2008, and where we were at the markets and what happened, hitting that just awful, 666 on the S&P, and now you're over 2,000. So if you stuck to your disciplines and it was hard, you were rewarded for those efforts. There will be years like we are witnessing now where you have a fair amount of volatility and angst, and at the end of the day, you really haven't gotten much accomplished. You didn't get anything accomplished in the fixed income markets to speak of?
How about this, though, Chuck? I think the difference is under what people were accustomed to, a year like this, nobody would panic. Nobody would think too much. It would be like, oh, it's not like it was, but this is as bad as it gets. This is great. But because 2008 cut so deep and people got halved, I think what do they say? Once bitten, twice shy. When somebody feels any type of negative bias, it hits harder after you're coming out of something that was very deep. Fair comment?
No, Harry. Very, very fair. And the fact is that it's kind of like sleeping with one eye open all the time, and you can't, you can't do that.
It's not healthy.
I think that this all goes sort of full circle to without having a plan in place and understanding what your priorities are and what your goals and dreams. And I mean, people say, that's that sounds silly, but at the end of the day, without a plan, it really doesn't make much sense what you own and why you own it. So you need to kind of take a step back and say, if you haven't done it, you need to do it. And there's a lot of ways to get it accomplished, and that's where we start that process.
Because the years really do go by. If you think that you don't have to worry today because you're X age and you got all these years, if you don't get it done, if you don't get a plan with Chuck, and that's what I recommend you do, if you don't get your plan, and get a good handle on it, the next thing you know, it's 20, 30 years later, Chuck.
Harry, you excellent point. And I had this discussion with a client yesterday, and he had his first grandchild, and was debating whether or not to open a 529 or a custodial account. And then I went through a discussion with him, and how much to fund, when to fund, how often to fund, and I used some real life examples of our clients, and I used an example of myself where my children, when you and I started this show, our children were a lot younger than they are today, and
some of your children weren't born.
Exactly. So. So you take a look at that, and you say, okay, planning is extremely important.
Yes.
And look, every day there's a lot of noise in the market.
If you plan early, you actually it's much more manageable than if you start saving for college when the baby is 1 day old as opposed to 12.
There's a significant difference,
Holy
and
smokes.
it's like anything else. If you develop a plan, you stick to your plan, and you stick to your disciplines in good times and bad, and oftentimes it'll work. It should work to your benefit.
Brief time out. It's 30 minutes past the hour. Chuck can finish up on this part of his program when we come back, and then we will feather into the Fed. We'll get an update. My take on the Fed is they desperately want to raise interest rates. I don't think anything, dramatic, but they desperately want to do it. They just have not yet found the way to be able to do it. They could just pull the trigger, but every time they're about to do it, something seems to happen that pulls them back. And we'll see what Chuck has to say about that. That's my interpretation as a layperson to what has happened, because by all intents, maybe there would have been a couple of rate increases in the atmosphere that the Fed was looking at raising interest rates, but they haven't pulled the trigger even once. Thank you, Clerk. I'm Harry Hurley in the morning with Chuck Malamut, and we visit every single week in this hour with Chuck Malamut from Morgan Stanley, Managing Director of the Malamut Group at Morgan Stanley's Northfield office for all of your financial planning needs. Turn to Chuck and his team, 609-383-2010. 609-383-2010. Coming up right after the top of the hour, we have 15 minutes. It's quite an exclusive. A very famous, if you're involved in the sport of track and field, you've heard of a middle distance runner by the name of Susie Favor Hamilton. She was well known for her talent, also extremely well known because she's very attractive. And her story following her running career almost reads in the fiction section of the library, but I promise you it was nonfiction. It's all true. And her book is Fast Girl, A Life Spent Running from Madness. She had great fame, but she was dealing with mental illness, and there was an improper diagnosis and medication and all kinds of things that exacerbated her mental illness. And she wound up literally having a family, but also working secretly as a high-priced escort in Las Vegas. It is just, it's like a movie, like a Lifetime TV movie, only it's real. And that's coming up 15 minutes in the first part of the 9 o'clock hour. We're talking about your financial matters with Chuck Malamut. Did you have anything before we do a Fed update?
No, I think we can go right there. And you think about the last meeting prior to, probably about 3 weeks out prior to the meeting, everyone was convinced the Fed was going to make a move.
It was telegraphed.
But
what happened, though?
So now we're at the point where the pundits are saying that there's
It's not going to happen.
There's about a 30% chance of it happening before year end, during the December Fed meeting. Most are of the belief that it's going to happen in 2016, and we do need to get started. It benefits, certainly, it should benefit savers. It's going to benefit the economy. You think about, just take a look for a minute. Look at our growth right now. We are projecting that, when it's all said and done, when the numbers come in, that in the third quarter, economic growth was between 2 and 2.5%. So, and that was led, Harry, because of the consumer. The consumer during that quarter did in fact help. Inventories and trade, are going to be the drags, it looks like. So if we get the consumer on board, I know that you have talked on many occasions about where the economy should be. And, we're getting to the latter part of 2016 very quickly.
Do when you say get people on board, do people get on board when they're hearing about fractional, growth, like 2% and worse? I mean, does that get people on board?
No, I think what happens is you've had, obviously, that tax relief, as we'll call it, in the fact with lower energy prices. And the question is, will the consumer convert that, to spending, particularly during the holidays? So, all bets and all eyes are on that, and that the Fed's going to be looking at that as well.
I read a piece not long ago. I think it was a couple of weeks ago, Chuck. It was in this month, and maybe not even 2 weeks, but it was definitely the month of October. And they used this term liftoff. That's like a term the Fed uses, almost like a NASA term. And 6.5, 7 years ago, when they set the interest rates at near zero, it was to bolster the economy. Don't you get to the point where 7 years later, it's not, bolstering the economy, it's artificially like resuscitating, and that normal policies and procedures that would go into effect can't go into effect. And so at some point, they're going to have to pull the trigger.
Yeah, exactly. And I think
they're going to have to do it.
If the reports come in and the economy seems to be, quote, relatively stable, and globally speaking, you see improvement, it's going to give the Fed, the ability to go ahead and get started.
Are there also lasting consequences if they do this?
Well, Harry, I don't think there's going to be lasting consequences, because when you think about, there's been so much fanfare about a rate increase. So the question is, if you go ahead, or when you go ahead and have that first increase, how many are behind it? I can't imagine, based upon the economy as we know it today, on a comparative basis, when Greenspan was running the Fed, that you're going to have that stair-step type scenario where every meeting the Fed moves rates 25, 50 basis points. And if my memory serves me correctly, Harry, I think in one of those meetings they actually moved 75 basis points.
Yep.
So you're going to see, in all likelihood, 1, maybe 2. And I think the Fed's going to take a step back and say, okay, how are we doing? Because, the Fed is very, very concerned about inflation. And, they want to see some inflation. So what we think will happen over the next year, we're going to probably have a stronger economy, and we're going to have a tighter labor market. And as a result of all that, headline CPI inflation.
Borrowing costs return to more normal levels. I saw something, Chuck, that I thought was very relatable when I read this piece. I wish I would have printed it, but I do remember enough of it. It referred to the need to raise interest rates, which I hate it in a way, because you get used to something, and it's very nice if you can buy a car at like 1%. It's like free money. But I think it needs to be done because it's kind of like a doctor that has had you on medication. But you're not on that medication for life. You're on that medication to get well, and then you gradually get taken off the medication.
So
it's a good analogy, I think.
You think about, again, the Fed's looking for inflation. And when you look at year-over-year core CPI, as we know it today, is up 1.9%. And that's, Harry, the highest level that we've seen since July 2014. So the Fed wants that. They need, you need that inflation, as as one of the tools in your toolbox to be able to go in fact, raise rates. So if you look at the equity markets, as we talked about in the beginning of the hour, we've had, if you went away and came back, you would have said, well, geez, we went absolutely nowhere. But then if you polled the average retail investor, they're going to say, oh, my goodness, this was just awful. It was a horrible year. I'm down 12%. And that's not the case. When you look at it, investors are very, very anxious right now. They're extremely uneasy as to what happened with the recent sell-off. The S&P moved from top to bottom, or from the top, it was down 12% over 9 trading days. I mean, that creates some very, very anxious moments. And
by the way, in fairness to that, things have improved, because some people try to say hasn't improved at all. I looked up the other day, Chuck, in December of 2008, we lost 533,000 jobs in 1 month, and 1 month later, that was adjusted to 700 and I think 35,000 jobs. That's the most. The 533,000 was the most jobs lost since 1974. When you add that they were off by over 200,000, it takes it back even before that. So, in a fair examination of where we've come in the last 7 years, even though the amount of jobs being created is not healthy, we are in positive job creation.
We are. And so, Harry, if you relate that back to the market for a minute, you have, as I mentioned, we just had that awful August followed by not a great September. But if you look, what has transpired so far in October, if you stuck to your disciplines, the majority of those losses have, you've in fact recovered. So, that's created a fair amount of uneasiness with investors. U.S. equities, as we know them, Harry, have been in a fairly tight trading range, and we need to break out either on the upside, hopefully the upside and not the downside. If you look at the S&P, we've been trading this year between 1867 and an upper level of 2,050 to 2,100. So that's not a big move, and so we've seen some changes. We've seen value. We've seen a shift from growth stocks to more value stocks. The biotechs, as we know them, got beat up fairly significantly and have not recovered as much, as other parts of the other sectors within the S&P. So the average investor, as I mentioned, is getting a little tired from this, and it all gets down to the economy. And can the economy be positioned, to grow? That's very, very important, as we get to the latter part of 2015.
And as part of that has to start to take place.
And it has to start place fairly soon because, you think about it, we are literally...
Well, markets take this, a fair examination of all of this tells me that this is right. But could markets not like it and start to get hammered because interest rates are now increasing?
No. I don't think so. I think
is it already built in?
I think it's built in. If you take a look at what is as the way the fixed income markets have traded of late, and are actually prior to the August meeting, it was built in. We were going to get an increase. So I don't think the markets will be rattled by that. That's for sure. I think the markets are relieved that it didn't happen as of yet. But the markets clearly understand that it has to happen relatively sooner than later.
And like you said, it's not going to be something wild. It will be very small as we go.
Yeah, well, that's that.
Incremental baby steps.
Correct.
I think that's important because if you go 7 years, and it's actually more than that, with no rate increase, and you're at 0 to 0.25% over this entire period, you can't crush people all at once.
No, doesn't work well. And again, we have chatted about this. Brother Bill, mortgage refinancing, it's still out there. It's available if your credit is good. We don't envision long-term rates moving higher, but this is certainly, you certainly still have that opportunity to go ahead and take care of the that side of the balance sheet as well.
Is that your closing comment or
We're
anything
good.
you want to share?
No, we're good.
You've been listening to Chuck Malamut. Chuck Malamut from Morgan Stanley. He presents this program each and every week. Chuck, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. It is 48 minutes past the hour. We're going to break. Chuck, we will catch you in 1 week.
Harry, thanks for having me. Have a good week.
Sooner if emergent updates are required. I thought
Correct.
I'd throw that in there because Chuck does visit with us if things both good and challenging occur. Back in just a moment, if you want to jump in, a mini open forum segment. Then we have the champion runner, Susie Faber-Hamilton. I'm telling you, you're not going to believe this story. You're going to think it's made up, but it's all true. And her book is just so honest. I couldn't believe it, actually, the things she is writing about, and they're all true. That's coming up, and then from 9:20 until 10:06, wide open forum right here on Early in the Morning, WPG Talk Radio 1450, South Jersey's talk station.